With us, Larry Kantor of Barclays. Good to see you here. There's just a swirl of news. Let's just start with China. Was this a surprise?
A little bit, but we saw very disappointing data in April, and we knew the Chinese were going to come up with some more stimulus, and it was a question of the combination of monetary and fiscal. I think it's a good move.
Let's start with Chancellor Merkel in Europe, her comments this morning. Was this a surprise?
No, I don't think it's the same line. They're obviously resistant to the Eurobond idea. I think, look, there's two big risks in Europe right now. Obviously, the Greek exit question in the election on June 17th. The second thing, and it's, I think, a bigger issue, really, is money's pouring out of there, and especially Spain. And they need to do something to restore investor confidence, and especially with the Spanish banks, quickly. Yeah. Otherwise, that's going to fall apart. Chairman
Bernanke speaks. Markets really don't move. I read a number of research notes that yawned. Was this a surprise?
To me, no, but I do think there were people in the market. You notice equity markets aren't up quite as much as they were before.
And the Euros
there was some expectation of an announcement of a QE3 or something like that, and I don't think the Fed's ready to do that. Really, I think Bernanke's right. The problems in Europe have to be addressed by Europe. I don't think the slowdown in the U.S. is that big. I think a lot of this pattern was exaggerated by seasonals. I don't think payrolls ever really were up 250 a month, and they're not as weak as they look now.
I bring this all up in the humor of, was this a surprise? Was this a surprise? Was this a surprise? Because I'm hearing very rational economic thoughts, economic notes. I do not see tight correlations in the market that deem panic, and yet every day it seems, well, every 2 days it's back and forth and back and forth. Why are the markets, the vigilantes, so disjointed from the economists that don't seem to be that surprised?
Well, I guess it's because I don't think the economic slowdown is the big question. I think the big question is, are we going to get through the next few months here without a disaster? You know, the tail risk in Europe is the big question that's really hanging over the markets, about investors really pouring out of there, and you get a post-Lehman-like event of credit markets freezing and so forth. I think that's the real nervousness.
Let's get back on path. Dreaded first chart, folks. I love this chart. Reminds me of an Olivier Blanchard chart from the IMF, except it's our wage growth. From the GDP report, there's the glide path up. Things look good, and then we pause. And if you extrapolate, Larry, that glide path to the upper right, we're just nowhere back to the good feeling that we were with the Barclays relative optimism. When do we see wages pick up? When do we see incomes pick up?
Well, incomes are picking up, as the chart shows. But look, this is, the last expansion was a consumer, household, housing, debt-led expansion. That's not going to be this expansion. Now, you look at things like retail sales, they're actually holding up pretty well. Recently, it's actually investment spending that's faltered, not the consumer. So what happened is we went through a period early in the recovery where consumer spending was not following income, meaning the saving rate was going up. Now it is following income, and income's doing gradually better.
I love this chart because this is something I know you deal with every day. Relative optimism, here it is. This is a brand new chart. Population adjusted jobless claims. And you can see how different 73, 74 and the double recession of the 80s was. Yes, we had a big spike here, but really nothing. And we've come down nicely under that 400,000 mark. That's population in today's, the right side of the charts in today's. Actually, claims are pretty darn good, aren't they?
They are. I mean, we had quite a drop there from, say, summer, fall last year, where they were running, 430, 440, down to 365, and now they've come up to about 375. But that was quite a big drop, and really wasn't sustainable to go down at that pace. But
what's your GDP call 12 months forward?
2.5.
2.5-ish.
Yep, 2.5.
I would suggest you've brought it back a little bit.
We have,
right?
Yeah. It's a little. We're a little less optimistic given recent news, and it just seems this economy is stuck in a slow but steady recovery. And that may sound contradictory. So I don't think it's actually that fragile, but it's not that robust either.
Earlier this morning on Bloomberg Surveillance on Bloomberg Radio, I spoke with Terry Belton of JP Morgan, and I asked him, how do you change derivative strategies?
There's a lot less leverage in the system. I think when you're in front of binary risks, especially those that are political in nature, the only way really to hedge it is to just get risk down, get leverage down, and that's what we're seeing from our clients.
I love that a lot. Is that Larry Kantor with us from Barclays? Is that derivative strategist talk for what economists say is deleveraging? We're just really deleveraging everything, aren't we?
Yeah, I mean, when you've got this big tail risk out there we were talking about before, I mean, the only thing that investors can do is just pull risk down overall. It's very difficult to hedge these kinds of events.
I mean, Fannie and Freddie, we're talking 10 years or even more. When you think about deleveraging as a general phrase, how long does that process last?
I think for the American economy, this may sound like a shocking thing to say, I think it's pretty much over, actually. In other words, the banks now have much higher capital. They have a lot more liquid assets than they did before the crisis. If you look at the household sector, the saving rate looks like it's stabilizing. It went up a lot from around 0 to 4.5%, 5%, and now it's kind of leveled off. So I don't think that's really what's holding back the U.S. economy right now.
Right.
I think what's holding back the U.S. economy is that single-family housing has really gone nowhere.
Right.
It's up a little bit, but it collapses. And usually when the Feds cut rates this much and mortgage rates go down this much, you start seeing the bounce, and you're not seeing that. Until that really gets going, you're going to have a subpar recovery.
Alan, give me the Michael Gappin note that was just published moments ago by Barclays, and this on the chairman. We got a lot to talk about. Excuse me here. The chairman comments differ from the more dovish comments made last night by Vice Chairwoman Janet Yellen. The chair's views on the need for further balance sheet expansion differ, and this goes to this debate within the Fed. How contentious is the debate?
You know, I'm not sure how contentious it is, but a lot of times when you hear speeches or comments from the various members of the FOMC, a lot of that's just noise, because what really matters still, and this has been true forever, is what the chairman thinks. And I think the Fed wants to keep its powder dry here. You've got the June 17th Greek elections. We're not sure if there's going to be a Spanish bank recap plan or not. Why react now? It's not clear, as I agree with Fed Chairman Bernanke on this, that the U.S. economy is really slowing in any significant way. I think what happened is we had unusually warm weather this winter. A lot of outdoor workers were able to keep working, and the seasonals expect things to employment to fall a lot, and they pushed them up. And then in the spring, it's supposed to bounce back. And it didn't, because they never left.
It's equalizing.
Exactly.
Let's look at this chart. This speaks to the Barclays optimism, 2.5% GDP versus gloom. Larry, you can see here, total vehicle sales. Well, the fact is the glide path is more than constructive. When Dean Mackey and your team slices and dices this, do they still have an optimism of manufacturing output?
Well, medium term, yes. I mean, auto sales have come a long way, as the chart shows, but they're still not back to normal. So for a decade before the crisis, we were selling 16 to 17 million units a year. At the bottom of the depths of the crisis, we were down to 9. Now we're up to 14 or so. So we've still got a ways to go. But remember, in the first quarter, manufacturing output in the U.S. was up over 10% at an annual rate. That's not sustainable. So we're seeing it come off a little bit, but there's still more upside to go.
Let's look at this chart here. This is a reintroduction. We showed this chart 6 months ago, and we thank Doug Elmendorf at the CBO. The chairman had a headline out today, thanks to our Bloomberg News headline team in economics with Dan Moss, with a great job with those headlines, where he said, look, I just look at the CBO. Folks, I'm going to make this real simple. If you're clueless about fiscal policy and want to get smart, that's where you go. This chart is back to 1790, when Larry Kantor first cracked his microeconomics textbook. And you can see the Civil War there, and then the Depression, and then the debt boom of World War II. And I'm sorry, Larry, any American looking at this is a cause for concern, as the chairman voiced today.
Yeah, it is. It is a cause for concern. And I think, look, the markets are giving the U.S. a pass for right now, because the Treasury is financing itself more cheaply than just about it ever has.
Right.
But this won't last. In other words, if Congress and the president don't face this deficit problem, and I think it's the next couple of years, in a serious way, I think we can get into real trouble.
Bring up the Belton note, Ellie, and this goes right to what Larry's talking about. So here's a Belton over at J.P. Morgan, and this is an outlandish call, absolutely irresponsible. Treasury rates have reached all-time lows, but likely have more room to fall. We lower our mid-year 10-year forecast, 10-year yield forecast, to 1.4%. Look at that Ira jersey at Credit Suisse. He's out doing IRA. We turn tactically overweight gamma, which is moving around a lot. Gamma is acceleration and agitation, as the French say. So what you're saying is this isn't going to last. Maybe we go a little bit lower, flight to quality, whatever, Europe. When we go up, and this is the huge question for every viewer of every walk of life, when we go up, is it going to be in a manner where my viewers can react to it and adjust and adapt, whether they're sophisticates like you or they got a 201k?
Here's what I think it depends a lot on whether Congress and the president addresses fiscal policy in a timely manner. Because if it doesn't, and you get that one very bad Treasury auction that shocks everybody, it could be a nasty, disorderly rise in bond yields. I think if we have an election, as you know, in November, and if it looks like Congress is going to address the deficit seriously, and you come up with some kind of Bowles-Simpson type plan, a multi-trillion-dollar deficit
that gives you stability if and when rates go higher.
Then when the rates go higher, it'll be much more likely be in an orderly fashion and not disorderly. So I think that is critical.